Hey, what's up, stock compounders? Brad here. So, today I want to talk about an interview recently with Peter Lynch. He was interviewed by Bloomberg. And, the first part of the interview talks about his recent art donation to a university in Boston. But then he's asked about active versus passive investing. And he had some interesting things to say about that. So we're going to spend about 3 minutes listening to a snippet from this interview with Bloomberg and Peter Lynch. And then I'm going to play a short clip from Charlie Munger talking about the mutual fund industry and a practice that's pretty shady that I think kind of contrasts a little bit of what Peter Lynch is saying. So let's jump right into that. And then afterwards, I'll kind of share my thoughts about it.
We obviously we're Bloomberg here, and we have a lot of people who are interested in what you have to say. One of our colleagues just talked to Joel Tillinghast. He's going to retire next year, and we're wondering: this is certainly part of a changing of the guard at Fidelity, but probably more important, this era of the real active portfolio manager. What's your take? Is it over? Is passive really the way that we're headed?
See, Steve Weimer and Will Danoff and Joel Tillinghast, and on. We've had fund managers, year in year after beat the market. So, I think active is still fantastic. I think people are missing the boat. So that's my opinion. But these are factual. I mean, everybody says they're going to adopt a top quartile. When they have the shoulder, they're going to top quartile orthopedist or great heart. No one says they're going to bottom quartile gynecologist. So this is very measurable. Yeah. Our fund managers, our active guys have beaten the hell out of the market for 10, 20, 30 years. I think they'll keep doing it. So I think this move to passive is a mistake.
Yeah. Tell us more about that. You said, do you feel like the folks are missing the boat here? What do you mean?
Well, I think if you look at the record, I mean, this is very measurable. You look at the record of our funds versus the market, it's fantastic. I mean, that's after commissions, after fees. Those are numbers. I mean, look at you brought up Joel Tillinghast. Look at Steve Weimer. Look at Will Danoff. These are, there's plenty of other fund managers that have had great records too. I think Fidelity will beat the market.
So, Peter Lynch, so I'm looking at your stats. I mean, you averaged more than 29% over your term. Is anybody going to beat that?
I hope so.
Is anybody close?
I don't keep score. Yeah. I get 10 grandchildren. I just had number 10 6 weeks ago, so that's what I keep score on.
Congratulations.
Oh, congratulations.
Time is enough.
According to legend, there's an investment advisor with a large mailing list, and he sent a newsletter to half the names predicting the market would rise and the other half predicting it would fall. Then at the end of every quarter, he discarded the names to whom he sent the wrong prediction and repeated the process. After 2 years, he signed up the recipients who were amazed at his track record of predicting the market 8 quarters in a row. Does something like this scam actually apply in the world of investing, where we cherry pick successful investors after the fact and then anoint the lucky ones as geniuses?
Well, it's even worse than you think. What they do in creating new funds is create 10 or 12 of them, and then pick one that happens to win, and then they show the historical record forever, showing this big return. And, of course, the big return happened when they had practically no assets. And the return per dollar a year in those investment funds is terrible, but it looks great when you look at it in a historical record, and it's really fraudulent what they do. And what's interesting about the modern culture is that nobody in the mutual fund world seems to find that practice of picking a phony winner like that and then using it in the advertising as crooked and detestable. But of course it is crooked and detestable.
So there you go, guys. You've got Peter Lynch, who obviously made a killing as an active manager. 29+% annualized returns over 13 years. I think he took Magellan Fund from 18 million to 14 billion, okay, in those 13 years. Some of that was obviously money coming in from investors. It wasn't all returns. But incredible performance from Peter Lynch. What's interesting to me is both of these guys talking here, Peter Lynch and Charlie Munger, they're both in the active stock picking game. There's obviously a big difference where Peter Lynch, charged performance fees. Okay, he charged probably fixed fees. I don't exactly know how the Magellan Fund structure was, but I imagine there was a fixed fee, probably 2%, and then a percentage based on performance. Whereas Charlie Munger, there aren't any fixed fees. There aren't any fees for breathing. So it's just interesting to hear this contrast in thinking. And it's got me curious. Has Fidelity followed this similar practice of, starting all of these funds and just kind of sweeping the ones that don't perform under the rug? So when you look at historical performance of funds, all you're seeing is these funds that have performed really well. And I looked up Fidelity. There's a little article here under active management, beat the benchmark, a history of market outperformance. Even seemingly small amounts of excess return can lead to significantly better outcomes over time. That is very true. If you're compounding at 12% over decades versus 10%, it's going to be a dramatically different outcome. At Fidelity, 86% of our equity funds have beaten their benchmark over the manager's tenure. Okay, and that asterisk, although not all Fidelity equity funds are represented above, 86% of Fidelity equity funds managed by the same portfolio manager for at least 5 years are beating their benchmark over the manager's tenure. This is 31 of 36 funds. Okay. And you can see what the annual outperformance is. That's, this bar, how high it rises above zero. And it points out who these fund managers are. These are their last names down here. And it talks about the length of history of that particular fund, 31 years. It looks like it kind of goes down to the right. These two at the end here are 9 years. So, it looks great on the surface, right? 31 out of 36 funds beating the benchmark. If I were going to invest in a Fidelity fund, I'd want to know a little bit more, okay? What information are they not displaying here? And I'm not calling Peter Lynch a liar, mind you. I think it's just, it's important to contrast these different viewpoints. Obviously, Charlie Munger, one of the best in the game of investing, particularly active investing. And obviously, Peter Lynch is one of the best in the game as well. Monish Pabrai, the thing that really got him into investing was picking up One Up on Wall Street. And I think through that book, he found Warren Buffett, devoured everything by Buffett and Berkshire Hathaway, and he was off to the races. So clearly, Peter Lynch is one of the greats, okay? But I think it's really important to think critically even if it's an incredible investor, to think critically about what is being communicated. And personally, I don't know that 10 years is enough to really look at a track record of a fund and be comfortable that manager has outperformed because of skill. Okay, and not because of luck. I'd also want to look how many stocks are owned by each of these funds. How different are they really from the benchmark? Are these concentrated portfolios, or are these portfolios, that just want to beat the benchmark by a couple percentage points each year, right? They're not very different from the S&P 500. So I definitely want to know that. I'd like to see 15 or more years of performance, which obviously, the first 6 of these have 15 years or more of track record. That gets us through the crash of 2008, right? If you're only looking at performance after the last big crash, it's hard to tease out what is skill and maybe what is just leverage that these managers have used in good times to outperform the market. So there's a lot to consider here. I don't think it's a foregone conclusion that any of these funds are going to beat the market over time. Now, Sven Carlin put out some content around this as well, about Peter Lynch talking about how, this move to passive is a mistake. And, I'm not fully on board with that. One of the things Sven highlighted was that since 2009, the S&P is up like 7 times, okay? And that's not including dividends. So it's been an incredible recent period for passive investing. But to me, that doesn't necessarily mean it's a bad idea today. I don't like to compare today's price with past prices, because past prices, especially if you're cherry picking a bottom, that doesn't tell me what the value is, what the relationship is between price today and value today. All it tells me is the relationship between price today and price in some past period. And price can vary wildly compared to the actual value of these assets. So, and it's a different time, right? We've got to consider, what are interest rates, all of these different things that go into analyzing what businesses are worth today and what are the aggregate of businesses in the S&P 500 worth today. So, I'm not fully on board with what Peter Lynch is saying. I think there's a lot of value to passive, and in response to Sven as well. I wouldn't necessarily plow everything I own right now into passive, but I think if you can sort of dollar cost average into a passive strategy, maybe over the next couple years, say 2 to 3 years, I think you can do absolutely fine in a passive kind of S&P 500 mirroring approach. So that's kind of some of what came up for me listening to Peter Lynch's recent interview on Bloomberg. But seeing his track record, it's incredible what Peter Lynch was able to do during his tenure over the Magellan Fund. So I think that's all I wanted to share, guys. Let me know what you thought of this Peter Lynch interview. And I'm not even sure that this was the entire interview. I guess this was put out on Bloomberg Terminal back, I think it was December 7th. So this might just be a snippet that got picked up by this radio channel. I'm curious if any of you have seen a longer interview, a longer version of this interview with Bloomberg and Peter Lynch. If you have, let me know. I'd like to dig a little bit deeper into it. But this is what I found available to the public. I will link to this snippet of the interview in the description if you guys want to listen for yourself. Obviously, you listened here, so it's all of what Peter Lynch talks about related to investing is in this video. And then, of course, Charlie Munger's take on, these practices that mutual funds use, that he says it's really fraudulent what they do, right? And nobody in the mutual fund world seems to find the practice of cherry picking these phony winners crooked and detestable. But of course, Charlie Munger sees them as exactly that, crooked and detestable, these practices. So just wanted to share my quick take on Peter Lynch, bringing the contrarian in, Charlie Munger. Thank you, Charlie, for being a guest on this episode. And yeah, I'll leave it there. Thanks so much for watching. I'll see you all in the next one. Take care.